Emma Muhleman of Ascend Investment Management. Thank you so much for joining the Contrarian Investor Podcast today. We've been trying to do this interview for a very long time, back on the early days of the podcast in like 2019 or so, if memory serves. And so I'm very thrilled that I finally have you here in the flesh, or actually not, it's over Zoom, but whatever, to do this and to talk about interest rates. And you have a pretty contrarian view there. And what we're looking at now with interest rates is expectations that central banks the world over, starting with the Fed, are going to tighten rates, are going to raise interest rates next year, starting around the middle of next year. But you aren't buying it. Tell me why.
I think the market is for one thing, they're all herded onto this one side of the boat saying, hey, bonds are crap, like sell bonds. And they're going to find themselves off sides when the market can't structurally handle probably even the tapering. So, I mean, Jay Powell has not been quiet about broadcasting that they are extremely flexible and will change their stance as soon as they see anything that changes. And we saw in December, leading up to December 2018, and the infamous Powell pivot, when he had tapering on autopilot, quote unquote autopilot, which was a much less dovish stance than he has now. And then all of a sudden, December 2018, he goes from tapering to full on QE. So I wouldn't be surprised if we saw the tapering end before we ever even got to liftoff. Wow. In which case you'd see Eurodollar futures would be a great trade. I'm looking at December 2022. And also same with the 30-year treasury and the 10-year even. You
aren't concerned, or you don't think that inflation will force the Fed's hand? Non-transitory inflation. We've seen this. We just today had PPIs that came in a little higher.
So here's the thing. I don't think the Fed has control over supply side and supply side driven inflation. That's really a factor of shortages coming out of China and bottlenecks at LA ports. I don't think they want to suppress demand and suppress economic activity by raising rates. I just don't think they have it in them, to be frank. I think they want everything to be rosy, and markets are structurally extremely fragile because of all the stuff that the Fed's done for the last 10 years plus. There's also deflationary forces that are big, long-term and short-term. So in China, they are having, their huge property debt problem translates to consumers who are feeling a lot less wealthy because it's the money illusion, if you will. They have their money in an unfinished box of cement. What's happening is because of the problems in the property, a few, like Evergrande is like just the first domino to fall here. We've already had defaults from Modern Land, China Properties Group, Cynic Holdings, Fantasia, Fortune Land Development, Tahoe Group, and several others. I mean, not several, like dozens of others. I think 150. You're seeing a nationalization, I think, is what's going to happen with the property sector. Just like you saw with the coal sector in China between 2007 and 2012.